Very kind introduction. Thank you. So I'll tell you a story about that transition because I was approaching burnout. I was in private equity and, you can imagine, 90-hour weeks, planes, trains, and automobiles all over the place. And there were two moments for me that clicked and said, I've got to do something different. And one was we had just finished a deal with a gentleman that was on the verge of bankruptcy. Like a week later, he was in bankruptcy. We came in, re-engineered his balance sheet, did a reverse merger, got him to be the point where he was going from near bankruptcy to the CEO of a public company. He invited a few people to a bar to celebrate. I was one of them. And his toast for celebrating this great success was not, hey, thanks everyone for everything you did. It was not, I really appreciate it. It was not, you saved my life. It was, F everybody. I thought, wait a second. I just gave this man 4 months of my life. I've got to think, because I was at first like, maybe I'm not around the right kind of people. Second, I'm sitting in my office in New York at the time, the Lipstick Building, beautiful view, client comes in, and he is going on and on about how awesome my office is. My mother must be proud, my spouse must be proud, my kid, just like on. And I felt so embarrassed because I was thinking inside, I don't want to be here. I don't want to do this anymore. Professionally, 12 on a scale of 1 to 10. Everything else, totally out of whack. 1s and 2s. Fitness, family, finances, faith, just having fun. I got free from that, and it is my passion to help other people get free. You are in an industry where if you are not careful, it will consume you. So the question is, how do you do this from a place of passion and purpose, but also in a holistic way that you have a fulfilling life? One of the big things I hear people say is, well, when I get to fill in the blank, retirement, whatever, I'll then be able to enjoy it, but I'll grind until then. That's an awful idea. That's just an awful idea, honestly, right? We should live now as well. So here's the starting exercise. If you would please take out one of those pads, because I'm talking to academics, so I had to do an XY graph. I just had to. Take out one of those and put an XY graph on it. And on the horizontal line, that's money. The vertical is anxiety. A for you've seen this before? Okay, and so here's the deal. Draw a U in that graph with the bottom of the U kind of center on the horizontal. And then you put a dot at the bottom of the U. Yep, exactly. Bottom of the U is a dot. Okay, so when you look, that's the vision of your financial life cycle from cradle to grave, okay? You start off with very little money and high anxiety because how am I going to pay for this, that? I heard some people talk about student loans. It's just super anxiety because you just don't have enough. As you progress, you start earning money, saving money, and you get to the Goldilocks stage, which is the perfect amount of money so there's no anxiety and you have enough. But I know you're not going to believe me, but I promise you it's true. You start getting more than enough, the anxiety starts creeping up again. I've met people that are worth 10 million, 50 million, 300 million, and they have more anxiety than all of us in this room combined. Because now it's about how do I protect it? How do I save it? How do I make sure it gets to the right people? How do I not get taken advantage of? So the anxiety starts to go up again. Here is what financial planning does. If you take a dotted line and go way down towards the point where the two lines come together and you just do a dotted line across, it flattens the anxiety curve. No matter whether you're in the pre-Goldilocks or post-Goldilocks moment, you just flatten the anxiety curve. That's what planning allows you to do. That's the visual I want you to leave with today. When you think about, so here's the question for you. And it's a trick question because I've already sort of said it, right? It shouldn't be just when you stop working. It's really what's the vision you have for your life when you stop, but also what's the vision you have for your life now. That was the moment I had, and I said, I've got to live different. And as an example, if my wife were here, she'd be so mad at me for doing this, so don't tell her I did this, okay? As an example, now when I start my year, she and I go away once a year in November, right around her birthday, and do a planning meeting for the forward year. We start the planning meeting by putting in the calendar the most important things first. The most important thing to she and I is our vacations. So last year we scheduled Turkey and we scheduled Austria. What I'm recommending to you is start conditioning yourself to do that. Think about your vision and what you're trying to do and figure out how to do some of it now as opposed to postponing it all until then. Here's the other thing I want to say. Who knows what FIRE is? Yes, I love it. You were up first. What's FIRE? Yep, financial independence, retire early. That is a concept when I talk to early to mid-career professionals, especially in this space, they want out. Like the idea of, I'll wait till 67 or 69 and then get full Social Security and all that. 50, 48, how do I get out of here? That's a real concept. So as you think about these slides today, you'll see a lot of people in their 60s as the examples. If you're in your middle 30s and you have a FIRE thought process, same concept. You're just shortening the time frame, right? The other thing I want to point out is, so when I talk about build your career so you can live it forever, as opposed to having to grind and then leave. Who knows who Leslie Stahl is? Nobody knows who Leslie Stahl is? Thank you, thank you. Who's Leslie Stahl, Stacey? Yeah, 60 Minutes. And I know you're not supposed to talk about women's ages, but it's instructional, it's educational. She's in her 80s. She was on 60 Minutes Sunday. She's built a life she can live forever. She's managed to set up her life so that she can do what she loves, but not to have it consume her in the process. That's what my hope is for all of you. Because you're important. Like without you all, you and teachers, we're in a world of hurt. But those two professions, we got to do it right so you can do it long term. So here are 5 questions you want to answer for yourself. And I'm not a fan of reading slides, so I hope nobody's going to be disappointed. I'm not going to read the slides to you, okay? Everyone here has a medical degree. I know we can read. So here are the 5 questions we want to answer for ourselves, right? Some way that's personal to you. When I ask someone about planning or investing or retirement, the answer should not, it's not, I'm doing this because someone said I had to, or I should be doing this, or I have to do it. Personalize the answer. I love what Jake said about authenticity. Build a plan that's authentic to who you are so you can live it out. This one about time is so interesting. Here's a trend I'm seeing. If I ask most people in their mid-50s, early 60s with kids, a big part of their thought process in retirement is spending time with whom? Grandkids, right? Well, the big thing I'm seeing is many people are choosing not to have kids, right? So if that's my vision for retirement, where I'm going to spend my time, and I don't have grandkids, what do I do? That's why it's important to think about it now. Do me a favor, please, because you'll refer back to this as we talk today. On that piece of paper, do a fresh page, please. Down this left margin of whatever full pad you have, write your name first, and then in order, write the names that are important to you. So like my dad would be on there for me, my spouse would be on there, my kids would be on there. I have a childhood friend, he and I were practically born in the same hospital. We're still close, he would be on there. Your important people, your squad. Write that down, and I'm gonna just give you a minute to do that. All right, it looks like everyone's looking up. Okay, now do me a favor on your squad. Advance their ages, starting with yours, 5 years, 10 years, and 20 years. So you get the point. Start with yours, and then advance everybody's age, 5 years, 10 years, 20 years. And if you're in the room and kids are in your future, in that time frame, 5, 10, 20, maybe there's a child involved. That's what so you're mapping your who. And this is the big missing piece when people do planning. We get so lost in the mathematics, we forget about the who. You're mapping your who. And these are the people that are important to your planning, both in terms of why you do it and who you want to enjoy with. Because to me, the saddest thing in the world is Super Bowl, when they go to Disney World after the Super Bowl, everybody's familiar with this, the win, right? The saddest thing in the world is you have this incredible accomplishment and you have no one to celebrate it with. For me personally, that's not okay, right? This is your who. These are your people that you're going to be thinking about as you do the planning. So, first question, how will I find purpose and express my values? Here are the 3 most common values. 3 most common values: family, honesty, and I wrote this one down because it just doesn't make sense to me, respect. Those are the 3 most common values. If you search it, those are the 3 most common values. For me, my values: generosity, and kindness. What are your values? Values are beliefs in action. Beliefs in action. Stephen, what does this have to do with financial planning? Everything. Because your planning should be values-driven. Relationship is also one of my important values. That's why I left high finance and went into this business. Because now I can focus on every decision I make is through the lens of how it affects my important relationships. That's why this is important. Because if you said, well, you get the point. I'll leave it there. So what are your values? And if I were to ask the who you've listed on that page, if I said to them, tell me how this person, what are they going to be remembered for? If I asked the people on that list you just made, what is this person going to be remembered for? Would they give the same answer you were about to give me in terms of your values? Okay. Here's a case study now. You can see the details. The idea is mostly about taking care of her twin sister and spending time with the granddaughters. That was the driving principle for her retirement picture. Her values were family, as sort of anchoring it. That was the value for her, was family, so hence the sister and the grandbabies. In order to be able to pull this off, she had to make certain adjustments. And as I'm going through this, think about you. Where are you? When's your exit? The people on your list, what are your values? What adjustments would you have to make between the ways you're doing things now and that future point so you can actually stay true to the people and the values you espouse? So in this case, I love that it's a BMW, by the way. That's not what I would have recommended, but it's a BMW. Had to get a bigger car because the thought process, she would be shuttling the grandkids around, school, activities, dance, etc. So I had to get a bigger car. Had to save because you don't want to go into debt as you're nearing retirement, so I had to build up the reserve to pay cash for the car. Had to think about the cost of insurance because a bigger car, and in this case a nicer car, higher premiums on the auto insurance, so I had to think about how to manage that in terms of her monthly budget, so you got to make those adjustments. Had to think about how she would support her sister. Would her sister live in the house with her, or would she stay in a facility and she would go visit the sister in the facility? But do you see how it gets granular when you think about it? Start with your who, then your values, and then start building out your details. And then you can work with someone like me on, well, what does this mean mathematically? But if we don't do that work first, it's all kind of lost. It's just noise because it's not anchored in anything. Here's another thing I want you to just put on your piece of paper. So on a separate piece, and all these are going to come together in a second, do a bullseye. So you have the center, circle out, circle out, circle out. And when you think about your values and your purpose, you reference this document, okay? In the very center of the bullseye is you, self. Then you have your immediate family. Then you have your extended family. Then you have your local community. Then you go to the state level. Then you go national. Then you go global. My wife is from Korea. I was raised in West Africa. We are very insistent on helping kids. Part of our vision is global because we are from outside the US, culturally. I was born in Queens, New York. Anybody from New York here? Yes. So, but culturally, I'm West African, right? So for you, is your vision and purpose going to be more in the center of the nucleus, or are you going to expand out? Because the broader your reach, the more details it'll take to pull it off, right? The little bit more math it'll take. Maybe it takes more resources. But think about it, because then you don't fall into something by accident. You are being intentional about where you want to get to. That's the whole point of planning. I get to where I'm intending to get to with some variation, because life is a funny thing. You know, there's going to be a standard deviation around my goal, plus or minus. But with nothing, I'll totally miss it. The other big thing to think about is, and this is why I put self in the center, you know when you get on an airplane and the airbag, they tell you about the airbag falling, put your mask on first, right? It's important, it's true. And I actually heard your keynote, I think, say that yesterday, about taking care of yourselves, especially with what you do. If you're empty, it's very difficult to give to people, which is basically what you do every day. So my point is, this balancing act comes into play because I've got my people, I've got my vision, I've got my values, I see my purpose, I see the geography I'm going to be solving for, then it's a balancing act of how much of my resources do I use for me versus how much do I use for the other parts of the bullseye. And just being thoughtful about that and finding your balance. And because the biggest risk when you think about retirement, whether it's FIRE or not, traditional retirement, the biggest risks are longevity, inflation, taxes, medical costs. You all would have known the last, you see it every day. But those are the four kind of big things that make it hard for a nest egg to last a very long time. So here's what I would like to do. Take a second now. This is the most important thing you'll do today. Think about this for a little bit and document it. Just a couple of notes for yourself. A little bit of a North Star. What does it look like for you? And again, if you're 32 and you plan to be done by 48, fine. What are you going to be doing at 48? Okay, just for the sake of time, I'm going to keep going, but if we have time at the end, you can fill it in a little bit. So now let's look at Patrick. This is the question of time. First we did purpose and values, now we do time. How are you going to spend your time? Here's Patrick. Sold his company, made a good profit on it, so money's not his issue per se. Divorced, and wants to spend time playing golf with the grandkids again. You see that theme, which is so interesting to me because I'm seeing a shift there. The grandkids again, and teaching at the local college. That's how he wants to spend his time. I'm going to tell you something that I don't think you'll forget, okay? So who's heard of the terminology go-go years, slow-go years, no-go years? Have you heard that before? Is it obvious what I'm talking about? Yeah? So our bodies, there's a period of time when if you do the traditional retirement, where you will have incredible energy. So when I'm planning with people, we'll look at like 60 to 75. Big travel budgets, huge visiting budgets for grandkids. Investment activity, maybe if they're sort of affluent, they want to be engaged in companies still on a board level. Big money spent in those times. Then you go from like 75 to 85, where you start backing off a little bit. And then, depending on longevity, there's a point where you really assume you're not really spending much money anymore, but for medical costs. So the question is, and this goes back to the beginning, time is the only thing that none of us can cheat. So it's about, my big message to you today is whether you're 32 or 52, be super intentional about your time and set your finances up to support and leverage the way you want to spend your time. Because that's the only thing none of us can cheat, right? So in this case, for Patrick, just getting into his detail a little bit, I told you what he really wants to be doing with his time. You want to surround yourself with a team. So in Patrick's case, he's going to be dealing with how does he transfer resources to the next generation. So this is where lifetime gifting comes in. This is a comment I want to make to those of us that are in my peer group in the room who may have more resources at your disposal. Rather than thinking of estate planning as something that happens after you're gone, look at lifetime gifting as a way to see the benefit of your generosity for the next generation. So what that means is, let me oversimplify. If you are, if you're going to be over 13 million at death, inheritance tax kicks in at the federal level. So sometimes what people will do is say, well, if I'm going to be at 20, I will, in my lifetime, gift enough money so I bring my total value below the threshold, right? That's usually why people do it. I'm recommending you do it for emotional reasons. Even if you're below the threshold, think about gifting in lifetime, as opposed to leaving until after you're gone. And that's something for Patrick that's very important. Fund the 529s, pre-fund some trusts. The other thing about trust now, let me get into that a little bit again for those in my peer group here in the room. Think of a trust as just a separate living entity from you that you can give instructions to as to how to manage resources you put in the trust's hands. So trusts are for a couple of reasons. One, to avoid probate. Meaning when I die, if I've not told my stuff where to go and I haven't put it in trust, it all goes via the court system, unless it has a designated beneficiary. So a life insurance contract has a name on it. A bank account has a name on it. Your 401k or 403b has a name on it. So it will go where it's supposed to go. For other things, they'll go via the court system. So there's costs associated with that. That's probably not the worst thing, though. It's the loss of privacy. That's the worst thing. I don't know if anybody know the Sopranos in the room? Right, Sopranos. So when he died, he hadn't done any of this work. So his whole life got put across the news. Prince, another one who hadn't done the work, so his life gets in the news. That's the other value of a trust, is the privacy. Passes outside of probate, it does what it's supposed to do. The other thing about this is control. Control. Let's say my 3 kids, your 3 kids, your 2 kids, whatever. And you're like, if I go tomorrow, $2 million is going to go to them. How do I feel about that? Out of 10 parents, 2 of them are like, that'd be amazing. The other 8 are like, oh, no, I don't want to do that. This one's not quite ready. That one's really good, but I'm worried about people taking, the thing starts happening. So what a trust does is allows you to send the $2 million there and drip it on the kids or whomever you desire to go to in an orderly fashion. For example, they graduate or get an advanced degree, a certain amount of money. They are going to buy a house, you match the deposit. They are going to get married, the money goes towards the marriage. You control the money from the grave, so to speak. That's the other value of a trust to think about. Was that? I heard a laugh. I've never gotten a laugh to that before. That's the other value of trust. So think about it from that standpoint, okay? Yes. Yeah.
Like, as a trustee.
Oh, great question. Okay. So in my mind, you need to have, it's unusual to have all of this in one person, but what you are trying to have for the trustee is somebody who will embody your emotional EQ to your kids and your financial EQ to your kids, ideally. Because the person who's good at the math may not always be the best coddler. The person who's an incredible coddler may not be that good at the math. So ideally, you want to have a trust or trustees that will embody both of those things. If you have to pick one and not the other, do the mathematics, because then they will be emotionless and they'll make sure that it lasts as long as possible. But what that means then is I would take the opportunity to be as clear as possible in your trust documentation so there's not gray, because then you're not deferring a gray area to a trustee that has no emotional IQ. And as far as who can be trustees, so you want to have a primary and a backup. And if you're picking a trustee, you probably are thinking of someone plus or minus 5 years of your age, which I would do. But the problem is, they might predecease me or kind of not be long after me. So you got to have a backup that's much younger. I will just go off a little rabbit trail on the medical directive and the living will or living will, those kinds of documents. Having a primary and a backup is also important there too. Very, very important. Here's the last thing I'll say about that. Don't feel like the decision you make, you have to stick with for 25 years. That's what I also observe. People get so stressed about picking the right person, they do nothing. Pick someone, and I would say it actually is a good idea, your financial documents, your legal documents, to review them once a year thoroughly. Like my wife and I do that on our planning meeting. You might pick a time of year where you review it yourself or with your significant other, if that person is there, and then have an annual meeting you do with your financial team. And your team, you want to have a CPA, an attorney, and a financial advisor. No one of them is good enough. All 3 of them it takes to really navigate you through these issues.
You said CPA and financial advisor.
And an attorney. Yeah. And I'll come to you 1 second, because this question about the trust, for example, an accountant would have an answer for that, an attorney would have an answer for that, and a financial advisor would have an answer for that. All of them will give you pieces of the puzzle that together you'll get the whole thing. Because people have they speak from their perspective. And I've observed, because I'm an attorney, I observe it. I watch the lawyers saying things and leaving out certain parts they just don't care about. And then I watch the financial advisors saying things and leaving out parts they don't care about. You need all of it to make a good decision. Does that answer your question? Yes, ma'am.
No, when you were saying that, I was thinking that maybe it exists where you can have all those 3 people on the same team, like on the same company, but no. Typically not, right?
Typically not.
They're all different.
Yeah, typically not. Now, this is you're asking an implied question, which is, how do you get them on the same team? Here's my thought process, and this is not meant to be self-serving. It's just the meter versus not having the meter on. CPAs and attorneys have meters that run. Financial advisors don't. So make sure you have all 3 and allow the advisor to be sort of the what's the right, captain, coach, mediator. Somebody help me with a good word for this. Because that he or she will not have a meter running. but you want to interview them to ask them, how do you work with CPAs? Because you want to get their perspective. If they start saying, well, CPAs, they don't really know anything, I'll run like your hair's on fire, right? They should say something like, what I normally do is I give them a summary of the meeting notes. I invite them to participate in the meeting. If they decide not to, I will give them a summary after the meeting and will make no important decision before checking with your accountant or your attorney. That's what it should sound like. And if it doesn't sound like that, find somebody else.
When you say attorney, do you mean an estate attorney?
Yes, I mean an estate attorney. Thank you for helping me be clear. I mean an estate attorney, yeah. I mean, some of you will have the privilege of being in the business space, so you're going to need real estate attorneys and transactional attorneys and all that, but for this purpose, I'm talking about an estate attorney. Yeah. Yes?
Are trusts revocable or irrevocable?
Great question. Let me tell you the real life difference between those two things. Irrevocable, completely out of your estate, no longer belongs to you, belongs to this other entity. You have no rights or benefits for it, other than what's written in the document. Revocable, out, but you can pull it back in. That's why it's called irrevocable versus revocable. Why would you use the two? There's going to be an example later where she used it because she wanted to be able to control the lake home she was buying for the family and have full access rights to do whatever she wanted in her lifetime, but at her death, it goes to the next generation. Where you normally see irrevocable, if I am worried about my inheritance tax and I want to create a bucket of money to pay my inheritance tax at the date of my death, I'll get a life insurance policy owned by an irrevocable trust. So it's not in my estate. And at the date of my death, that money goes to pay my death tax. Most of you in this room, and I'm going to say something, please don't get me in trouble, because like your business, if somebody comes to you and says, can I have a prescription for such and such? You'd be like, can I ask you a few questions first? Right? So generally, you're going to be looking at revocable trusts in your planning, generally. But it is very fact specific, so I'm happy to talk to you in detail. Oh, good question. Thank you. Thank you. All right, so let's talk about a property. Should you have your real estate in a trust? If you are at a certain net worth, I would say yes. And the reason I would say yes is because you want to isolate the legal risk of owning and operating real estate from your personal assets. That's the primary reason. Am I making sense when I say that? It's not so much because if you own an apartment building, we live in a litigious society. Someone slips and falls, someone gets hurt at your property, you will be named in the suit. And so moving the property out of your name so you don't think of a series of condos with a retaining wall between the two. If a fire starts in one, it might burn all the way to the others. You're trying to put a fire retardant between your personal assets and those assets. You want the revenue, but you don't want the litigation and the legal risk and all the other things. So that is the reason to move them out of your name. Now, should you put it into a trust versus into an LLC? That's a question about your estate planning. So if this is partially estate planning, then you go the route of the trust, and there's a real estate specific trust that can be set up for that. If it's really just about the legal risk, you could just move it into an entity. You need to make sure your lenders, if you still have debt, are in that discussion because they might have feelings about that. And then the other thing I'll say is make sure your property and casualty, this is the biggest thing I see with people who own real estate, they don't have adequate property and casualty insurance. Umbrella is what people talk about. Make sure, because for the protection you get, it is worth the few $1,000s. Because if something goes wrong, it will be devastating. So make sure you have adequate property. Go over on the property and casualty if you can. I see you both. You had another question about living will. Okay. I'm going to tell you the key documents without using terminology, because that's the problem. Like, people use these terms and they become interchangeable, and it just messes everything up. One, you want to have someone who is going to make your financial decisions to the extent they need to do that either short-term or indefinitely. That's typically called a power of attorney, and can either be what they call springing, which means it comes into effect if something happens to you, or it can be set for a date certain, right? Then you have the person who's going to make the medical decisions for you to the extent you are unable to, short or long term. That's your living will. Medical directive. The reason why they use all those terms is because you not only pick a person, but then you all know better than I do, you make decisions about Do I want to be on life support? To what extent? How aggressive do I want you to be to save my life? That sort of thing. All of that gets documented in those documents. And then the last thing is the will. The will is just there to tell your stuff that doesn't know where to go, where to go. Think collectibles, jewelry, cars, homes. They don't have designated beneficiaries in the line, so you got to tell it where to go.
And you need one of those if you have a trust, or if you have a trust, you don't need a will.
Both. You do both. You do both.
You need a will.
You need a will and a trust. Yeah. Trust is trust, and I see everybody. I'm coming to you. Trust is you do the basic will, power of attorney, medical directive, living will, same thing. Then you do the trust if you have the need. You should be above a certain net worth, either currently or on a projected basis. That's the other thing I want to say to you all in this room. Please, it's not about where you are today. It's about where you could be on a projected basis. Let me give you a for instance. I worked with a business owner, and the time we worked together, he was 41. At that point, he was worth about $6 million. And he was below the threshold. Well, the problem is, if you looked at his growth rate, by the time he was 62, he was really worth way above the threshold. So estate planning is today and projected. Especially for some of you in the room, you have the ability to be fairly high earners. So you got to look at that on a forward basis, okay? I think you were next.
So my first question, I think about my primary
Yeah.
that needs to go into a trust. And then you mentioned that that net worth, what would be that number?
Thank you for clarifying for me. It's so funny. What I heard is additional real estate, not primary home. So now that we've clarified that, I think for the primary home, depends on your estate plan, but yes, you could put, if it's debt-free, it would make sense to put it into a trust. Particularly if you've got other things that you can put in there, because then you can set up a distribution plan for the next generation out of the trust. Yeah. Your net worth, you want to look at your state and your federal level. So if you have state inheritance tax and you're going to be above that, you got to start doing some trust. And then on a federal level, right now it's around $13 million per spouse, but it's meant to sunset at the end of this year, and it could go down to about $7 million per spouse. So 26 or 14 million federal, and it depends on where you live on a state level. Some states have no inheritance tax. Yes. Yes. Yeah. Yeah. Good question. Good question. So let me. Okay. You have the different kinds of insurances. You have homeowners insurance. Usually your bank will be like, you're buying homeowners insurance because if something happens, I want to get my loan back. So they're specific to your home. You have your medical insurance. You have your auto insurance. You have your life insurance. You have your disability insurance. Property and casualty is an umbrella policy that sits over all your stuff and will pay out if somebody slips and falls at your house. Your homeowner's insurance may or may not cover it. If you lose your home to, okay, this will make the point. I'm going to tell you this, it's true. I'm telling you, I'm not making this up. I had a client whose house got struck by lightning. Got struck by lightning. The homeowner's insurance did not cover it as an act of God. His property and casualty covered it. So the property and casualty is rebuilding the house and put him up in a very nice hotel. Thank you very much. So you just got to look at the gaps. Did that help to at least put some more clarity on it?
It's something that you have to get separately.
Yeah. There are people who do property and casualty. So you just talk to one of them. And anything I say here, email me, get on my calendar, I can point you in the right direction, right? Yes?
How do you make sure you have a good financial advisor?
Ooh. Okay, I'm going to give you my 2 cents, okay? The first thing I would make sure is they listen to you. And I say that and it's like, well, duh, but no, it's not a duh. Because some financial advisors have their way, and you're going to do it their way. So I would make sure they're listening to you, because the thing about an advisor is they should be a true partner in your life to help you go through the ups and downs. Because the thing about planning is once it's done, it's obsolete and it's unlikely to work out the way you planned. That's just the way things are. So that's the first thing. Second, credentials. CFP, I have a JD, CLU, CHFC, credentials would be another thing. Another thing you would look at is ask them about their process. What's your process for onboarding a client, and what's your process for annual reviews with a client? Because if somebody can't answer that question with clarity to your satisfaction, that's a bit of a red flag. So those would be things I would say. Yes. Oh, I'm sorry. I'm so sorry. Were you next?
I don't know.
Do you mind? Do you mind if I just get her? Yes.
On the topic of a good financial advisor,
Mm-hmm.
can you talk a little bit about how financial advisors make money and what kind of their motivation is for helping us?
You're my hero. I just want you to know, okay, if I had a gift card, she would get it. Because number one, she sat in the front of the class when the place was empty, okay? Number two, that's a brave question, but nobody asked it. It's a brave question. All right, so here's how financial advisors work. You have commission-based advisors, which means that when a product is acquired, there's a commission built into the product. It's called the sales concession, and out of that, they get paid. So if you bought a life insurance contract and you spent $1,000 of annual premium, they might make $500 or $600. It's a portion of, it's built into the product itself, so that's commission-based. The other kind of advisor would be what's called fee-based, but there's two versions of this. One is going to be an advisor that gets paid fees based on assets they manage for you. So they manage $1 million, and they charge you 1%. So that fee will be paid to them typically quarterly or annually, and for that, they're at your disposal. You call them about refinancing the car, buying a home, buying a vacation home, giving a gift. They're at your disposal. The third way an advisor would get paid is a fee for a plan. So not related to assets, they would charge a fee to put together a written financial plan for you, and they could even work with you to make adjustments and changes as necessary. The fees there, they cap out around $400 an hour, and depending on the advisor, it could be $1,000 to $2,500. Sometimes I've seen them get as high as $10,000 where a business is involved because it gets a bit more complicated. So those would be the ways that advisor gets paid. Great question. Yes.
So my question was that question, so now I have a follow-up.
Yes.
So
Dig into this. Go.
what's a reasonable percentage?
Okay, let me start with that, and I'll go to the recommended. So a reasonable percentage should be have breakpoints. It should cap out at 1.5%, and it should come down as the account gets larger. So the low end of that range I've seen, this is for a $10 million account, 25 basis points. 25 basis points is basically a quarter of 1%. That's at the low end, and 1.5 at the high end. So if you have a $10,000, $25,000, $50,000 account, it's okay to pay 1.5%. And do the math for me. I don't do math in my head because we have calculators. What's 50,000 times 1.5%? Someone, anyone. No one's looking at their calculator. Everybody's looking at me. What? Can someone please do it on a calculator? Everybody's afraid of the calculator. What is it? Times 1.5%. No. Point. Yeah.
That's what I said.
Okay. You have this. You want to become a financial advisor? No? So $750. So think about that. Paying $750 a year for you to be able to call someone and ask them whatever you want, or is it relates to money?
So 2% is too much.
Yeah, people shouldn't be charging 2% because you also have to have the advisor's fee, and then you have the fees of the investments that he or she puts you into. And the fees of the investments could range from 10 basis points to, if it's something that's like tax loss harvesting, it could be 75 basis points. So you really want to look at not just their fee, but the all-in fee. But I would say you get what you pay for. This is an area where you get what you pay for. If someone's very quick to discount their fees, you should be a little nervous. You should, honestly, right? I mean, it's like, go ahead. Yeah.
Do you still need a separate financial advisor?
I'm going to repeat the question, make sure I heard it. The bank, you're with Wells Fargo, and Wells Fargo has assigned you an advisor to work with. Do you still need an advisor? Let me answer your question this way. Take whatever written plan you've gotten from your Wells Fargo advisor and get a second opinion, and then answer your own question. I saw a hand. Yes. I'm sorry. What's your... Okay. Yep. Okay. You have your educational planning. That's for dependents. You have your investment planning. You have retirement planning. You have your risk management. So that's like if something goes wrong. Let me back up and do it this way. What is financial planning? Protecting myself against what can go wrong, so I have the luxury to invest in what can go right. That's basically what financial planning is. And the CFP, which is the most well-known designation in our business, says you have to first protect yourself. It's the foundation of the pyramid. That's your disability insurance, life insurance, long-term care insurance, and that's your having emergency funds, right? So you have an advisor that will help you with all of that, figure out what's right for you and your family and all that. Once you've taken care of your protection, then you move to investing. And your investing will start with generally mutual funds, and then you can move up the pyramid. So the top of the pyramid would be like commodities, art, wine as an investment. But you start at basic mutual funds, and then you work your way up to individual stocks, and then you work your way up to commodities and that sort of thing. And the financial advisor should be able to be with you through that whole journey. Let me put it to you this way, because I like visuals. I'm a very visual person. A good financial advisor should be able to literally take you and put you in a time machine and take you to say, and have dinner with your 55-year-old self. I'm just picking an age. And say, here's your life, here's where you live, here's what it costs you to do that, here's how your kids are doing, and you should say, I like that. Let's keep doing what we're doing, or that's awful. I'd rather make some changes. That's really what financial advice does. So you can adjust your plan before the mistakes happen.
I wanted to go back to the fees.
Yes.
So, to the point that the first one you said, the commission-based, is that commission-based on, like, if you have a financial advisor who is doing, like, your investments and things like that, the fee, is that off of the investment, or that is, like, a fee you just pay at the very end?
So if you are doing investments, the fee is applied to the amount of investments you have and is paid to them on an ongoing basis.
Out of the investment?
It'd be out of the investments, yeah.
I
Yeah.
mean, off of the increase from the investment.
Correct. If you are doing a plan with no advice, you get the plan, they deliver it, you pay the fee, $1,500, $2,000, whatever it is. If the plan calls for life insurance, you go get the life insurance, they would get a commission when the product is placed. Yeah. And to answer the elephant in the room, yes, I'm an advisor. I'm available to help you. And I would look at what you're doing and then give you a proposal. Because where I am in my life, it's really more about making sure you're going to be okay than me making a few bucks here or there. Thankfully, I'm beyond that. I saw a hand over here.
So I have a financial planner who goes by the fee per plan.
Yes.
So 350 plans each time. She comes up with this plan.
Yeah.
That to me is of dubious value because I get these pages and pages
Yeah.
of, with the little dials, provided that an asteroid doesn't crash through your roof on Friday and you live to be 150 and you don't get this bacteria, you'll have 85% chance of success.
Right.
And there's all these lines and lines of variables.
Yeah.
Like if this happens, it'll change it to 70%.
Yeah.
If this happens, so it's so confusing to me. My best friend happens to be a CPA and a tax attorney.
Yes.
And he says, that's just stupid. Just figure out how much you need to live, because I'm a lot closer to retirement than most people here. How much are you going to need to live, and how much can you bring in between your Social Security and your investment? It's that simple.
Yeah.
So I guess what I'm asking is, what should we expect from a good fee for plan? What should they be giving me to be more helpful?
So thank you for asking that question. And yes, the software will generate a lot of pages, okay? But a good planner should be able to take that and distill it to a single page that you understand. It's not just the plan, it's you understanding the plan. A good planner should put him or herself out of business because once they explain it to you, you understand it and you can actually repeat it to somebody else. That's how you know you have a good planner. Because our business, people get very excited about their terminology. And so they start throwing Monte Carlo simulation and alpha and, whoa. Just make it simple. Yeah, so that should be a good planner. And depending on your situation, your friend is correct, but what if something goes wrong? Because if you need, I'm gonna give you a great lifestyle. If you need $25,000 to live monthly, and you between what you can take from your retirement accounts, your Social Security, and if you have a pension, you have $30,000 available to you, everything feels amazing. But You just got to go through a couple of things. What if I need medical care? What if somebody I feel obligated to spend money on needs medical care? What if my investments don't do as well? So you do just want to test some things. So it is simple, but you just got to test it to make sure it's going to work. And that's where the annual checking in comes in. Thank you. So you all did great. I mean, we got into it in the questions. Yes. Great question. Umbrella is going to be a synonym for property and casualty, normally what people, when they say umbrella. Yeah. Let me just make sure we covered everything. This was awesome. Oh, to your question, someone nearer to retirement. So when you're nearer to retirement, there's 3 buckets: your emergency fund, your guaranteed income, and your variable bucket. So emergency, everybody knows what that is. Your guaranteed is like the replacement of your paycheck. Building a bucket of assets that does that and does that exclusively. And then your variable would be the excess to have fun with, take trips, go to dinner, etc. So break your assets into those 3 components, because for the guaranteed bucket, I can take less risk because it has to be, there's my paycheck. For the variable, I can control whether I go to Paris this month or next year, so I can take a little bit more risk, right? So think of it that way. Break your assets up that way. And then for us, so that we're not at the great escape point yet, your buckets are going to be short, mid, and long term. And what I would ask you to do is, and please do this, write down what you want to do or what outcomes you want in the short, mid, and long term. Short is less than 5 years, long is 60 plus, mid is everything between. What outcomes do you want? Because now you have your who and your outcomes. The plan is just the math behind that to achieve it. The other quick thing I'll say is long-term care. Please address that. Please, please address that. If you haven't addressed it and you're in your mid-40s, you should address it, because you can either assume you're going to pay for it out of your pocket. You can assume you're going to use Medicaid, which I really would not do that if you don't have to, or you can use third-party insurance to do it. And there's different ways to do it. Please look into that. The other thing I'll say is Social Security. If you've got a 5 in front of your age, you're probably going to get Social Security. If you don't, we should be talking about what the options are, right? And so having Social Security income planning is important to know what you can expect. And that's a whole planning module, actually, Social Security income planning. And just know that goes directly to my calendar. I'll spend 30 minutes with any of you, kind of getting you organized. If you want to go further than that, we can talk about the details. I'm generally fee-based because I'd rather not be adversary to you. So that's why I generally do fee-based. I think I was able to cover everything, which is yes.